Okay, good morning, everyone. We want to try to get started this morning. Glad everybody made it back. Good crowd for this early in the morning, and hopefully this will be very beneficial, and you'll all be able to say, I was here when this happened, and nobody else was. So, thank you. The Benefit Providers Panel obviously has been a long-standing tradition with the National HBPA. Benefits providers from the affiliate level is extremely important, and what each, especially executive directors, go through with the benefits and the benevolence within the affiliates is something that really opens topics for discussion, and each affiliate can and certainly help others and learn from others. So when we have these panel discussions, I think it's a great aspect of the organization, and our committee chairs, Richard Riedel and MaryAnn O'Connell, have done a great job at trying to facilitate good discussion, timely discussion, and certainly educational material. So with that, I will turn it over now to Richard.
Thank you, Eric. Good morning, everyone. Just wanted to remind you that today's session is sponsored by the Louisiana, Finger Lakes, New England, and Virginia HBPA affiliates. Our format today is we have 3 guest speakers. Each one will present for 20 minutes. We'll try to keep it to 20. Okay. So our first speaker is Dr. Reed McClellan, who is observing his 15th year as Executive Director of the Groom Elite Program. In 2012, he was the National HBPA's Man of the Year. Reed is with us this morning to provide an update to this celebrated Groom Elite Program.
Thank you, Richard. I really don't know who all's here because my eyes don't work in this kind of light anymore. I see John there. But I'm glad those of you that are here. I'm glad to see we have so many Baptists here. Since the front rows are all empty, I'm sure that's what that means. Just a quick update on Groom Elite Program classes-wise. Last year we did Gulfstream, and as this year, for the first time in 12 years, we are not doing Gulfstream at this time of year. So I had to spend the winter in Kentucky, and I learned something up there that actually is going to be included in the talk as I get to it here in just a minute. The other aspect of it is we did Presque Isle Downs for the first time last year. We did 99 and 101, and also the first Thoroughbred Horsemen's Association track, Laurel Park. We did 99 and then 101 and 201. So that was real beneficial last year. They both committed to another program this year. Prairie Meadows, which has done a class virtually every year since about 2004, is going to be on for 201. Virginia, which did a class pretty much every year from 2003, and then until they didn't race anymore. And I'm looking forward to being back at Colonial for a program in August when they get started. So that's kind of the update. Now, as I was being asked, what do you do at the convention? And I said, well, I make a talk. And so then I decided that would be the title of my little presentation today, talk. So then I had to look up and say, actually, what is a talk? And as a noun, it's a discussion between important people from opposing sides designed to help them agree about something. Obviously, we don't talk very much. I mean, we may get the first part, but getting them to agree about something we only get about halfway through the talk on that part. Then it's a verb. And that is speaking in order to give information or express ideas or feelings, converse or communicate by spoken word. We do a pretty good job of that. And we've had some good talks here, and I've learned some stuff, and I enjoy it every year that we have information and education exchange when we come to the convention. And then I thought, well, what is it really? Talking is making noise with our vocal cords so that others think we know something. Sometimes we just talk. because the longer I talk, the more you don't know what I don't know. A second thing is we don't have to take action. I mean, after all, we are talking about it. And too often, I think in our industry, that's something we do way too much. Then we can keep others from taking action. And we've seen that in our political structures and stuff. People, the filibuster, that's one of the things it's about. It's just keeping other people from being able to take action. And then the one that really gets to me is others think we really care about what we're talking about. And particularly when an owner stands on the dais and receives his Eclipse Award, or he stands on the stand at at Churchill Downs or Pimlico or Belmont after his horse has won a classic or maybe a Triple Crown, and says, we couldn't have done it without Jose or Juan or Mary or whoever it is that actually is holding the horse down there. And then they go home and they pat themselves on the back and they talk about how much they appreciate the grooms, and yet they won't invest $650 to $750 per groom to have them have an opportunity to learn about the horses with which they work. And so that's really where I came to what spurred me when I was thinking about this. I'm doing a class in Lexington next week called Philosophy and Methods of Training Racehorses. I've got, I think, 8 people signed up for it. And most of them are owners. There's 3 of them in there that are planning on taking the trainer's exam. One of them's already taken it and passed. We're gonna be looking at the different aspects of training racehorses. And one of the things I looked up was the definition of trainer, and then some synonyms. And one of the synonyms is bronco buster. Another synonym is pricker, P-R-I-C-K-E-R. And then there's some other similar types of synonyms, basically mean that a person who prepares something for a contest, when we get down to that part of training. And it doesn't talk about really managing. But what we do in our classes and what you do when you're sitting around is we use the same principles that horses use when they talk to each other. I teach the grooms about the horse body language. These horses right here just look like a group of 3 horses that might be running around in a field getting into mischief, and yet those 3 horses are each saying something to the other horses in that field. Then horses talk to us. Sometimes I get up in the morning, I feel like Sam here. I just don't really want to get up and go do it again. And then I talk to humans. And I find people that want to learn about horses and want to know about racehorses and want to know about thoroughbreds, and I can't wonder how I wouldn't do this again. And then I get a chance to go out and talk to horses. And sometimes the horses don't do exactly what it is I'm asking them to do, but if we learn the techniques of communicating with horses, then we can find that place of peace and harmony with our horse. And if we could do the same thing with humans, we could arrive at that place where we could actually get a lot more done. I always tell the grooms that pressure and release. You ask a horse to do something, it does what you want him to do, you release the pressure. And one of the things I point out to them, that I have a very effective, positive reinforcement. Is that when a horse is doing something that I want him to do, you said 20 minutes.
Yeah. Thanks, Reed. Any questions for Reed?
Going to need the time.
No, I don't need time. No questions? Okay, so we'll move on then. Next, Peter Eckerbert joins us to provide an update on the benefits and consequences for nonprofits now that the full effects of the 2018 tax reform are better known. Peter is General Counsel for the National HBPA. He will also examine a couple of recent cases of equine law and order.
Okay, thanks, Richard. basically, I wanted to go over some of the tax law changes initially for nonprofits as well as for horse owners and farm owners. Here, I'll figure out how to use this thing. The first area I wanted to cover was for nonprofits, and today there always has been a tax for a nonprofit on your unrelated business income, the UBI. That's income that a tax exempt, like an HBPA or like your foundation, may earn by activities that are more of a commercial nature, where you're competing with other businesses. The tax today is a little lower than it used to be. It's at 21%, which is the maximum corporate rate. But the change that affects negatively a nonprofit is that each unrelated business activity has to be kept separate, so that if you have a loss, say in your in one of the activities, if you've got a business going on to help raise funds, like a gift shop or something along those lines, and you generate a loss in that activity, and you have another activity like you have a newsletter that you sell, or some other activity that you have of a commercial basis where you're generating income, that then that loss from the gift shop cannot be offset against the income that you may have from the newsletter or whatever the activity may be. Basically, though, that it has to be an unrelated business activity. So not every activity that you engage in as an HBPA or as a benevolent organization, or your benevolent function, be that a trust or whatever it may be, is necessarily taxed. It has to be an unrelated type that's not connected with your nonprofit mission or nonprofit purposes. The other change that somewhat affects nonprofits as far as the unrelated business income is concerned is that there's no longer a carryback of any net operating losses, only carry forward. And the maximum that on a carry forward that can be used is 80% of the income from the nonprofit's UBI in that particular year. Some of the other changes that have an effect on the charitable foundations that we may or may not have, that National has a charitable foundation and many of the affiliates have charitable foundations that allow for people to make contributions to the foundation and then obtain a charitable deduction for the contribution that they make. Generally the dues and money that's transferred to the HBPA, the affiliate, under a 501c6 situation, excuse me, it's too early, my voice isn't working, is a business-related type expense. But where you're going out to the general public and asking them for contributions for the charitable purpose that your foundation was set up to establish, then that becomes a charitable deduction. And some of the reasons that those charitable deductions have been adversely impacted is because the changes to the tax law that have lowered the individual tax rates. So a charitable deduction isn't necessarily as beneficial as it used to be if you have higher tax rates, of course. The other thing that adversely impacts it is the state and local tax deduction has been capped at 10%. And the reason that's adverse to the charities is because not as many people will itemize their deductions if they're capped at $10,000 for your state and local tax deduction. And the other part is good in one way but bad for the charities is that the standard deduction has been doubled. That means that less people are going to itemize their deductions. As a result, there's less of an incentive to make a charitable contribution if one of the incentives to do that was the tax benefits of that deduction. And then further, the estate tax exemption has been increased, doubled basically, so that many or a large percentage of people will never have to worry about the estate taxes, the federal estate taxes that start out at 50%, the tax rate. So that, I mean, that's a good thing, a bad thing for charities because less people are going to be leaving charitable bequests in their wills when they pass along. For the charitable foundations, remains a requirement that they acknowledge any gifts that are made, and that letter acknowledgement is something you need to, it's not only good business practice to thank somebody for their contribution, but it's also an IRS requirement that they would look at if they came in to audit, that there is actually a letter, acknowledgement letter that you've sent out to let with the necessary information on there as to the individual, as to the amount and all that was contributed. Let's see here. Now, the other part of the tax law changes that have been beneficial impact the horse owners and farm owners, and the primary and some of these changes require another look at your business operations to decide if there's things that need to be changed or things that you can take advantage of to get a deduction, or to maybe forego a deduction if you're in a situation where it may make sense to. It sounds crazy, but sometimes it's better to maybe accumulate all your deductions in a particular year and maybe have an income in another year because you don't take the deduction, that then getting away from some of the hobby loss provisions that have become more restrictive, which I'll explain as we go along. The first thing, obviously, that when you're getting into the business or your farm, or you buy a horse and get into the business, you want to check as to how you set that up. What kind of entity do I put this in? Do I stay as a sole proprietor, or do I go in some type of entity? Now, a C corporation, which is a regular corporation, has a maximum 21% tax rate, which is better than obviously the maximum tax rate for individuals, which is at 37%. So it may well be that you decide that you want to go with the regular C corporation. The potential downside to doing that is the double taxation issue. And how that comes into play is that a corporation, as long as it accumulates its income and doesn't distribute it out and is using it to reinvest and to buy other property and whatnot, there won't be a double tax. It'll be that maximum 21% tax. But if the corporation then decides to pay a dividend, then there's no deduction to the corporation for that dividend, and the individual receiving the dividend is subject to tax on the amount of the dividend. Now, there are ways to get around that by making expenses and payments to individuals as compensation, where they would still have to recognize the income, but the entity, the C corporation, would get a deduction. But again, this type of an entity is used primarily for large syndicate type horse ownership, where you've got a number of owners and that come in as basically a shareholder, a minority shareholder in a regular C corporation. And when they get out, then it doesn't create a situation where you have a real complicated reporting mess where you potentially would with a limited liability corporation or an S corporation, which would require you to do some allocations and reporting with respect to the income that's been generated to the point of the departure of that individual. Yes, it is. Yeah. LLC is like an S corporation in that sense, in that it's a flow-through for tax purposes. And the beauty of the LLC, the good thing and the bad thing of the LLC is, one, from tax purposes, it's a good thing because of the flow-through, in that you're only taxed the one time, and you're taxed at whatever your individual rate is, or whatever the individual rates of the members of the LLC happen to be. The negative thing, I guess, with the LLC is it's a relatively new entity. I mean, you may think that sounds crazy because it was, it's been around since the 60s, and that seems a lot younger every day to me. But anyway, that's there isn't necessarily the volume of case law as there is with the corporations to determine in different situations how the courts will react or handle an LLC. Generally, it's been positive to this point. In most states that have LLCs, like Kentucky, they generally treat the LLC as a corporation and apply corporate type doctrine to it, but that's not necessarily a 100% guarantee, because there are some differences in that you get into like a partnership situation, and a lot of states will look at the partnership law with respect to the LLC as opposed to the corporate law. That's maybe too much minutia, but any event, one of the real benefits to the new tax law has to do with the bonus depreciation. And this bonus depreciation has been increased from a 50% level to a 100% level. And the other thing is it's expanded to all property that's purchased and put into service after September of 2017. So if you buy a tractor, if you buy a horse, if you buy, a farm that's got fencing and tangible property on it, you're able to expense that property without limit, and it's also not limited by the amount of income that you have. It can cause a loss situation, and you can use that loss against other income. There are some restrictions if it's a passive activity, but if it's an active activity, you can apply that a loss against other income. So that this is a real benefit, and a real sort of like back. I'm dating myself, but they used to have an incentive to get taxpayers to purchase equipment by the investment tax credit. And that would give you a credit regardless if you owed tax or not, and you could apply the tax credit and whether you owed tax as to that activity. If you had taxes on other things, that investment tax credit was just applicable across the board. This is very similar to that in that you're getting 100% bonus depreciation. The nice thing also about this new provision that I think is a real business stimulant is that it allows for you to elect out of it, so that if you decide that you don't want to take the bonus depreciation a particular year, you can do that. And it is governed by the time that the asset that you place in service, so that if you were to buy a weanling, and you're not going to start training the weanling, obviously, for another year, or maybe not race it and not really place it in service for 2 years, so it's a 2-year-old, you wouldn't be able to elect bonus depreciation. The requirement is for property that's placed in service. So the place in service requirement would dictate then that the depreciation deduction would come into play when that horse is placed in service, when it goes into training or when it goes on the racetrack. Then you can take that deduction. But you can also, as to equipment that is placed in service, you can elect out of it, so that if it makes more sense in your situation to elect out of it, you may want to do that. And again, the reason I raised that again, and I'll get into more detail, is because of the hobby loss restrictions. They expanded the definition of what's allowed to encompass breeding stock that was not previously owned. So that if you owned a horse and then you go back and buy it back, that wouldn't qualify for bonus depreciation. But if you and some other individuals owned a horse and you decide to buy them out, then you're not the previous owner of that percentage of the horse. So if you went in 50-50 with somebody and you decided to buy that person out, then that 50% that you're paying qualifies for bonus depreciation. So that would maybe be a real incentive if you decided to do that, because you're going to get an immediate tax write-off for the amount that you're paying for the balance of the horse. The other equine assets that could qualify, not only the racehorses, but like I say, the equipment, the fencing, land improvements, and barns. And that's, if you're thinking about buying some property, it's important that you have that designated. In other words, you go in and have an appraisal made so that you have an appraisal on what's the land value, but also appraisal as to what is the value of the fencing, what's the value of the barns, what's the value of the improvements that are on that property, so that those would qualify for this bonus depreciation. But you've got to have an objective standard, and at best, where the IRS really can't dispute that, if that's in your purchase and sale documents. So it will eventually start to fade out, but right now, and through January of 2023, it's 100% bonus depreciation. It will phase down 20% after that each year, so that by the time we get to 2026, it'll just be 20% is allowed as bonus depreciation. So it's good to act while it's still at 100%, and actually, it's going to stay there for a few years. Let's see. One of the things, too, is that it's sort of like easier to designate or to discuss what's not qualified for this bonus depreciation. So horses that you previously owned, horses that are used primarily outside the U.S. So this only applies to U.S. property, because this was the idea, I think, that Congress put this in, or the reason they put it in, was to try and stimulate the U.S. economy by generating purchases of tangible property in the U.S. and create, help the economy out. If horses that are purchased from related parties or obtained by gift or inheritance do not qualify either. So you can't set some scheme up. Well, I shouldn't say scheme, but some idea with your immediate family and start transferring things around, because that related party transaction won't qualify. And horses are not eligible if they're not placed in service. They have to be placed in service. So weanling would not necessarily be eligible, nor would horses that are held in inventory. So if you're a pinhooker and you're just going to be selling the horses and they're up for sale, that's inventory and would not necessarily qualify for the bonus depreciation. The other thing that's still around is the 179 expensing, and this is limited. It's increased to $1 million, but it is limited and will start to phase out. And the other limitation on it is the net income from the activity. So it has to be an active business that you're involved in. So if you're in a horse business, an active in a horse business, that's great, but you have to have net income from that in order for this 179 expense to be applicable or to be able to be used. Regular depreciation changes that have been somewhat helpful are that the 200% double declining balance depreciation is allowed, and there's no, it used to be that certain items were restricted to 150%, but this is allowed across the board. So if you want to elect 200%, that's available. There's a 5-year recovery period on equine assets now. It used to be 7. Unfortunately, there's still a 3-year recovery period. There's a 7-year recovery period on yearlings they're trying to get that changed. There's a bill in Congress to knock that down to 3, and I don't think there's much opposition to that. So hopefully in the near future, we'll see the 3-year recovery period apply for yearlings. Now the other thing that they really haven't changed is that you still have the hobby loss restrictions, which comes to bite anybody in the horse businesses. I think that the IRS on their audit manual, when it comes to auditing horse farms or horse owners, that has to be in red ink, that they look at that, the hobby loss, because what they're looking at is that you have to be running your operation as a business, and this, and not just a side deal that you're trying to get write-offs, and it's fun to get out to the horse track, and like some people have done. But the courts are being more accepting of the fact that just because the horse business is fun doesn't mean it's a hobby. If you're running your business as a business and you're keeping records, you're evaluating and trying to make a profit, then it should be a business. But what's made this hobby loss provision even more restrictive is that it's a double-edged sword that's and really like a sword. It cuts in that no expenses are allowed for your business if it's found to be a hobby. So if it's found to be a hobby, you still have to report the income, but you can't take any deductions that are related to it. So that in itself is a double negative that has just come in and applies for the years 2018 through 2025. Hopefully that'll get changed, but that's not something that anybody's really making any effort to change. So that not allowing the deductions makes it even a bigger negative than it was in the past. The IRS in their regulations, when they look at the hobby loss situation, they have 9 factors that they use to determine whether the activity is a business or a hobby. And what those 9 factors really boil down to is, are you really conducting this operation as a business? Do you look at, is your primary motive a profit motive, or is it just an excuse to try and beat somebody that also owns horses or whatever? But here it's other businesses, it's a 2 and 5 year test. Here it's a 2 and 7 year test. So if you have profits in 2 of 7 years, what happens then is the burden shifts to the IRS to prove that you don't have the necessary motive, the profit motive that's required. If you don't have a profit in 2 of the 7 years, then the burden's on you, and it's a difficult burden. But so it's good. I mean, it's imperative that you keep good records, that you have, you evaluate and consult with experts, that that you're active in trying to show a profit. And the other thing that the courts have recognized, which is a good thing, is they recognize that the appreciation and value of your farm, of your horses, and that you may not be generating a profit on an annual basis, but over the long term, when you look at what's going on, your accumulation of actually appreciated property is going in the right direction. So and hopefully, they will take that into consideration. And even if you do have a loss, if you're really trying to make a profit and evaluating things the way you normally would with a business, then you've got a real strong argument, and unbelievably so. But the tax court last year came down and found for the taxpayer in a situation where this was like a side business, a lawyer who had a farm that he was really not active in at all, but the court thought that he did do the minimum and was able to convince the tax court, which if you do anything in tax law, the tax court is so biased towards the IRS that it sometimes causes you to have heartburn. Okay, I'm sorry. I get winded. Okay, I'll get wrapping it up. One of the other things that is still in play is that active participation, so that you need to be active in your and this is not really with regard to the hobby, but regard to whether or not you are able to take losses against other income. So if you're active in your horse business, that means that you're actually going in there and attending races where your horse is running. You're conferring with advisors. You're selecting the horses. You're looking at the bloodlines. You're discussing things with your trainer and others, and you're trying to make a profit. Now, to be active in the horse business, you have to devote 500 hours a year to the activity, so that you've got to keep records of your travel time to and from the farm and whatnot. That all is important and all applies for that 500-hour level. And the spouse, both spouses, that counts as one. So if you and your spouse, both of you are working on it, that all counts for the 500. So most people that are active are going to reach that $500 level without a lot of problem. Where there hasn't been any changes is like in involuntary conversions. So if you have a horse that dies or something happens where you get insurance on that, you still have 2 years to reinvest. Also, another item that hasn't changed is a holding period for horses. To get long-term capital gains for a business asset in the horse business, for cattle or for horses, is still a 24-month situation, as opposed to, like if you own stock or something, you hold it for 12 months, you'll get long-term capital gain treatment. In the horse business, it's not, that's not the case. It's got to be 24 months. Some of the negative changes are that they tightened up the like-kind exchange so that you can't necessarily exchange one tangible asset for another with no tax consequences. It still applies to real estate, but to all other property, the like-kind exchange, the tax-free exchange, is no longer available. They also made some changes to meals and entertainment, so there's no deduction for entertainment or for amusement or recreation. There's still the 50% deduction for food and drink where it has a business connection, and there's also a restriction now where meals that were given to employees for the convenience of the employer. So like during foaling season, if you want your employees there and you're getting them food, that now is limited to 50%, whereas the old rule was 100%. So that's a quick overview of some of the, am I on time? It's okay, okay. Of the changes, and I think my time has expired, so I'll turn the podium back to Richard. Okay.
Thank you, Peter. Any questions for Peter?
I have one question.
Go ahead, MaryAnn.
What was the 179?
Oh, that's like a depreciation deduction that you're allowed to deduct, but it's limited to $1 million. Well, it's $1 million, but it's like bonus depreciation, but it's more restrictive in that you have to have income in order to take that 179, and it reduces, obviously, like bonus depreciation does, the value of the asset that you purchase for future depreciation purposes. But you can take the bonus depreciation of 20% on the year that you or the 179 in the year that you purchase the asset.
The bonus depreciation is not limited to income?
That's right. It's not. 179 is. That's right. Yes.
Anything else? Okay, we'll move on. Claudia Goebel will next provide us with a presentation regarding sexual harassment in the workplace. Claudia is a member of the Minnesota HBPA Board of Directors. She is able to bring a unique perspective to the issue as she is a horsewoman, having grown up in a racing family, and has worked 20-plus years as a human resources management professional in a wide variety of business industries. Claudia?
Good morning, everyone. As Richard said, I am one of the Minnesota Board of Directors, and in my day job, I will preface this, I'm not an attorney, so I'm kind of a subject matter expert, on human resources. So in my day job, to pay for my horse racing industry, I work in the human resource field, and for about 25 years. So in my role, many of you don't have a human resource department, but in my role, my job is to handle and resolve a variety of simple issues of attendance to very complex issues such as sexual harassment or discrimination claims, hopefully before they get to a legal or a court level or a Department of Human Rights charge. This had all started from last year's convention. We had a panel discussion on the Me Too movement. I was really hoping in the meantime, in the last year, that things would die down, we wouldn't hear as much headlines, but unfortunately that hasn't been the case, and in some cases it's gotten worse. I never really ever thought my passion for horses and horse racing and my HR career would cross over, but here we are. In my opinion, regardless of whether your workplace is the backside of a racetrack, a farm, an office environment, which is my typical workplace, these all boil down to being a workplace, being a place of employment. where bottom line, all employees should feel comfortable coming to work and being treated with professionalism and respect. In my opinion, well, we've all heard in the headlines the names Harvey Weinstein, Kevin Spacey, Chef Mario Batali, all famous names and their behaviors from years past that we've all publicly heard about their behaviors. We've all heard about them from in the last few years. We most often hear lately about individuals saying and doing very inappropriate, offensive, unprofessional, and sometimes illegal actions. In today's society, sexual harassment has gone way far, far beyond a coworker asking another coworker out on a date and being told no and not taking no for an answer the first time. Harassment also does not discriminate. It can involve opposite sexes or, regardless of your personal beliefs, same sex. And anyone can be accused of harassment. Anyone. We have a really litigious society these days, and that is something that I take into account on a daily basis. I think it's also important to note, with regard to reporting a sexual harassment complaint, not everyone is comfortable bringing forth a complaint for various reasons. He or she might be afraid of retaliation, which can be very, very real. Supervisor retaliation in my office environment, or just simply that person can be afraid of or feels intimidated by making a claim. So here's where I come in as an HR professional. Another important thing to note, I think, is that not everyone is going to find the same level of something said or something done. They're not going to find it offensive. I personally, from working in HR for 20 plus years, I'm not easily offended, but what each of you might find offensive or what I might find offensive can and will be completely different. Employees often tell me that what they said or what they did, they meant it as a joke. Well, that may have been the intent of the initial conversation, but when someone along the line, the conversation may have become too casual, maybe in a barn environment. I've worked in a field too where the workplace was residential homes. The conversation got really casual. It went well past a joking nature, and then someone got offended. My advisement to employees is if you ever question, and I kind of use this in my life judgment too, if you ever question saying something out loud to a coworker or someone in the workplace, it may be best not to say it. Or I tell employees, ask yourself these questions. Would you say this in front of a child, spouse, or parent? Would we act this way if a grandparent was with us? Or third, would you want your actions reported in a newspaper? We all know how the news headlines treat our horse racing industry while they grab onto sexual harassment claims very easily too, the negative aspects. Common sense isn't always so common, and unfortunately, bad behavior and employees' use of poor judgment is my job security and keeps me employed. In my work world, when an employee makes a claim of sexual harassment or offensive behavior, even though it's my job, I'm obligated to act. If we fail to investigate and we sweep the reported behavior under the proverbial rug, not only can the employer be sued, but so can an individual, supervisor, manager, me as an HR professional for not acting and taking any action. On the flip side, are false harassment claims made? Of course. But I always advise due diligence. A quote-unquote investigation doesn't need to involve, a huge number of questions, a days-on-end investigation. just ask a few questions. False claims and reports will not go unnoticed either and will lead to some sort of disciplinary action in my work world. So in closing, I have so many stories I could share with you, both true and false claims. Bottom line, if an employee tells you someone did something, said or did something offensive, made a sexual advance toward them, or an actual real incident that I had to recently deal with, and without going into graphic details, I had an employee send a video on Facebook during work time to a client exposing body parts that he definitely should not have. And it was totally inappropriate. I'm not kidding you. I was appalled, and it took me a little bit. It takes a lot to get me appalled. So again, I say, regardless of whether your workplace is a barn or an office, I really encourage managers and supervisors, trainers, to, when something is reported to you, to stop and listen and stop the behavior. Because if you don't, take your pick, bad, wrong, or illegal behavior can come back to haunt years later. Just refer to the headlines: Harvey Weinstein, Kevin Spacey, Mari Batali. Personally, I would really rather read about all of us having racing wins than about bad behaviors. Thank you.
Thank you, Claudia. We'll take questions from the audience for Claudia. Anyone? I have one, Claudia. For a lack of better terminology, I'll call this third-party harassment, okay? I have an all-female staff. 3 are Hispanic ladies, and I don't think there's much chance I'm going to harass these ladies, but our clientele might. They may say things inappropriate. They may make references to their ethnicity. And their tone may be ugly. And what I don't speak a word of Spanish, but I can listen to tones in the office. And when I hear tones and loudness, I generally float by and things settle down. But what type of obligation do I have as an employer to protect my employees against this third-party harassment?
An employer does have an obligation, because whether it's a client, and then it gets touchy because you have a client relationship and they're paying for your services. But it's really important to stop it and talk to a client as well and listen to the employees and get their side of the story. There's 2 sides of a story to everything. Is it working? Oh, okay. There's 2 sides of a story. So get the employee side, talk to the client, and it's really important to get in front of that and let the client know. So oftentimes, people aren't aware of their actions. Really, they're not. They're not self-aware. And I think it's really important to bring that to their attention.
Thank you. Anyone else have questions? Okay, well, that brings us to a close for this, the second part of the National Benefit Providers Committee meeting. I would like to thank everyone for attending. The attendance did grow as we got along with the program. And just a reminder about the green evaluation sheets. If you would, at this time, please complete those. Give them to MaryAnn or myself. If you still need a sheet, I've got some, or there are some out on the table in the hallway. So with that, we'll turn it back over to Eric. Thank you very much.